Exclusive chat with ET now. My colleague Ankur Mishra caught up with Moody's and ICRA to try and understand about the health of the financial sector and, of course, growth targets for the same as well. Here are an excerpt.
For the NBFC sector, the conventional asset segments like the home loans and the vehicle, these two segments together account for almost 44-45% of the overall book. They will grow at a stable pace of about 14-15%. The driver will not be one segment unlike what we saw this year and maybe the previous year. It will be all segments will operate in a very, very narrow range in terms of growth over the next financial year. Most of them will be in the, if I have to put it a broader range, it will be somewhere close to about 15-20%. The larger asset segments will operate in the 15% range. Segments like LAP will grow possibly at a higher rate, about 20-odd%. But the other key segments will all grow in that 14-15% range, which will result in a broader, average of about 17-18%. The unsecured segment, which saw very strong growth coming out of COVID. It has moderated from those levels of what we saw, maybe a 40% growth in the consumer finance and personal loan, etc. In 2023, 2024, it has come down to 24%. It's in the current financial year. We would see that also to grow at close to about 18-20%. So if I have to categorize these broad asset segments, the secured, conventional asset segments will be growing at about 14-15-16%. LAP, personal loans, these are the segments which will grow at about 18-20%. So the broader weighted average number would be somewhere close to about 17% for the next financial year.
Right. Mr. Pandey, you expect low to mid-teen growth for banking loans in FY 26-27. Where do you see it will come from? It will be more of a retail credit, or you think that there is going to be corporate capex revival next year?
So we continue to expect higher credit growth in the retail segments and SME, and followed by the corporate. We do think that the capex is running at a healthy clip in India, and that's why the GDP is growing at a certain level. But we don't see any divergent in terms of a rise in capex from these levels. And we should also notice that the avenues that the corporates have to finance the capex have changed in India. A lot of them are financing through their internal accruals, bond market, equity markets, and external borrowings as well.